Thank you very much indeed, Peter. My name is Rupert Taylor. I represent a small independent data analytics company called AltFi Data. And I'd like to start by commending all of you for being here. It feels like doing back-to-back data sessions is a little bit like having double maths in the last period before lunch. But at that point, I would also like to distinguish. Actually, I need to find a clicker at some point as well. Hang on. There we go. I would like to start by distinguishing between the various different types of data that are relevant in this emerging asset class, because I think sometimes it's too easy to lump them all in together and not recognize the distinctions. We've just seen some incredibly impressive volume-type data, aggregated data, which is a monumental task to find out exactly how much of this alternative finance is going on around the world and get a sense of what the impact is so we can help regulators form policy, what impact it's having on the banks, etc. There's also the kind of data which the platforms themselves are sourcing to help them assess credit risk. Arguably, it's the most important data in this space. And separate to that, what I'm going to talk about is data relating to lending track record. So this is all about track record. And now I've explained what it is I'm going to talk about. If you're a service provider, I would encourage you to stay. If you're a platform or a regulator or an investor, I hope you don't need any encouragement, because I think being serious about disclosing track record of lending performance is absolutely critical to the evolution and scaling of this asset class. So let's start by reminding ourselves why disclosure and transparency is so important. We hear these words all the time. And the reality is we mustn't shy away from acknowledging that there is an agent-principal conflict at the very heart of the marketplace lending model. In fact, it is arguably the secret sauce within the model. It's what keeps it efficient. It's what keeps it light. But we have to recognize that we have to mitigate any perceived conflict here. And the way to do this is using disclosure. Because disclosure, if delivered effectively, can create an incredibly powerful alignment. And in fact, it can create an economic alignment. And the logic here is that this is an internet-based industry. Investors are free to choose. If we can find a way to represent lending track record in a timely and accurate fashion, then if investors don't like the quality of loans they're seeing, if they don't think they're being funded at sensible rates, they're free to go. They're free to invest in something else. They're free to invest in a different platform. Now, given that the revenue model of these platforms is very closely tied to loan matching fees, that actually creates an incredibly powerful economic alignment. But there's a catch, and that is that all of this relies on effective disclosure. To provide that sort of timely insight, the disclosure needs to be effective. And it's worth doing, because we have to acknowledge that there is a synergistic need here, okay? The need of the platform and the investor is the same. If trust can be created, it will encourage adoption. And if we can encourage adoption from a wider pool of investors, it'll help the asset class scale. And I think at this point we have to acknowledge something slightly uncomfortable, and that is that there are two huge pools of investors who as yet have proven reluctant to adopt this asset class. On the retail side, the vast majority of the savings and pensions market is hidden behind the advisor wall. IFAs and wealth managers are responsible for all that money. Now, IFAs and wealth managers have to prove suitability. They have to prove they've done due diligence. So we have to make it easy for them to do that. On the institutional side, the ultimate owner of this microloan asset class are vanilla credit and fixed income investors. We have to find a way of getting this microloan asset class into conventional vanilla fixed income mandates. And at the moment, that is not the case. So what is it we need to deliver these investors? We need to deliver these investors the ability to do due diligence on asset performance, track record. And we have to deliver that to them in a manner that is quantitative and, importantly, objective. This kind of analysis relies on objectivity. We have to let the figures speak for themselves. And as a result, we cannot rely on surveys. And I would also argue that we cannot rely on the platforms representing their own data. It's totally accurate, it's totally valid, but there's a layer of credibility that can be brought by using an independent third party. So, what is it investors need to see? Well, I believe what investors need to see is track record of net lending on a like-for-like comparable basis, and all the other credit metrics that the wider credit industry is used to seeing, and in a language they understand, to common existing credit market standards. So let's have a look at what's out there, and let's figure out if it's effective. Well, the previous presentation showed the range of data out there around the world, and this image gives a small representation of the extent to which there is much more going on in the UK than the rest of Europe at the moment. Even at today's newfound sterling exchange rate, you can see in accumulative origination terms, the UK is far ahead of Europe. And as I've said before, there is a lot of excellent data out there with regard to size and volume and origination, and this is very useful in terms of shaping the way the industry is regulated, but it's not going to help us deliver due diligence. Now, at this point, I want to commend the P2P FA for the incredible job it's done in terms of helping the industry get some very forward-thinking regulation, get a dedicated regulatory regime. And another very useful thing the P2P FA has done is establish standard definitions. And this could be extremely helpful in terms of aiding comparability platform to platform. I would signal a note of caution, though, and that is that getting these standard definitions interpreted in a consistent fashion is hard, and we don't see that happening at the moment. And we also think these definitions should be in line with wider credit market conventions, because that will ease adoption. So what we see at the moment when we look at data disclosure is we see that the platforms are working very hard to disclose their own data. And as I say, standard definitions definitely help that process. So here we can see a snapshot of a load of continental European platforms that are doing a great job of representing their data in colourful and very valid ways. The same is the case in the UK. And indeed, there's some more granularity normally in the UK, partly with the help of standard definitions. However, my view is that there are two shortcomings of this approach. The first is that the platform can never deliver the credibility of this analysis that an independent third party can. I think independent third party verification and validation should be encouraged. But the second point is, even if standard definitions are universally interpreted, there's a big problem, which is that calculation methodologies differ. So if you look at each platform's representation of their net returns, not only is the calculation methodology different, not only is the actual calculation different, normally the entire approach is different. So here we see a snapshot of 3 perfectly valid ways of trying to discern net return at the platform level. All those are, sorry, they're not even all equations, which arguably represents the issue, which is that all these platforms have a good way of analyzing and discerning their net returns, but they're totally incomparable. Standard definitions do not create a standard, because a standard calculation methodology is a whole nother step removed, and probably extremely hard to achieve a consensus on what that standard should be. If we move beyond platforms representing their own net lending track record, the other standard which is broadly out there, and which is definitely a representation of the right intent, is static loan book disclosure. However, for me, static loan book disclosure is not delivering effective transparency. The first issue is that these files are enormous. They're measured in the megabytes. They are well beyond the remit of a standard home computer. They're stretching the ability of the average professional investor. Even if you can handle the file, which comes in an inconsistent format, to create any kind of lending track record, you've got to stitch together a whole series of these files. This is a massive analytical task. And even then, your output is not necessarily comparable because you haven't got standard fields, you're not sure the definitions are interpreted correctly. This is not making it easy for investors to do due diligence on a large scale. Now, at this point, I think we have to reflect on a comment that Lord Turner made, which is to say that we have to learn from the past. And I think it's important to recognize that there, in fact, was disclosure in MBS in the US. Aside from being a great movie, The Big Short illustrates to us Dr. Michael Burry leafing through page after page of mortgage disclosures. Now, it didn't help that the rating agencies created the impression that they'd done the analysis and there was nothing to be concerned about, so nobody needs to look into those telephone directory-sized books of disclosures. But the fact remains, disclosure was there. And it is therefore not enough just to disclose information. We have to disclose information in a format that is digestible. And only then will we allow scrutiny to be brought to bear. And by allowing scrutiny to be brought to bear, we will create confidence and we will encourage investor adoption. It is in our interests to allow ourselves to be scrutinized. But the right sort of scrutiny can only be delivered if we try and create some kind of quantitative, objective standard. So let's look at what's out there at the moment. And a lot of thought has gone into various methodologies to delivering disclosure. But my view is we still haven't cracked it. Because if we look at what's out there at the moment, platforms representing their own statistics is always going to struggle for credibility. On top of that, it's not comparable because calculation methodologies are different. I've put platform-derived statistics plus there for the UK context where we do have standard definitions. That helps at some level of comparability, but still you're not getting a net return analysis on a like-for-like basis. So we have to recognize that just doing disclosure is not enough. If we want to learn from the lessons of the past, we have to do disclosure in a way that allows scrutiny to be brought to bear. And if we can do that, we're going to encourage vanilla fixed income mandates. We're going to encourage IFAs to actually take the plunge and invest in this industry, unlocking enormous market opportunities which could deliver the scale that this industry has at its fingertips. And I would add, needs to make itself a sustainable model. So, how do we establish a quantitative standard of measuring asset performance? What's interesting is we're extremely close. This industry actually has all the tools to deliver this. It has tech and disclosure in its DNA. And actually, we believe that with the assistance of some of the biggest, most transparent, forward-thinking platforms in the UK, we have been able to demonstrate what can be done if an independent third-party analytics company is trusted to take the most granular disclosure, loan-by-loan cash flow disclosure. It is possible to turn that into output which is easily digestible, comparable, and standardized. And I believe this is the beginning of the sort of objective quantitative framework that I'm talking about. So very briefly, just to give you a sense of what this output looks like, here is net lending across the 4 largest by origination UK platforms. Now, interestingly, this is net lending. This is something we need to recognize is arguably more useful than just raw origination. We need to know net of what's being paid back. What is the industry actually doing in terms of achieving scale? I hasten to add and actually apologize that the September data is in, but I didn't make it into the presentation in time for the slide cutoff. And there has been a rebound in the last month, not only from an origination perspective, but also from a net lending perspective. Equally, the kind of granularity that we can deliver allows consistent analysis. Now, it's really important that I explain this slide to you. So this is a selection of Zopa's arrears lines by risk grade, and the blue line is Zopa's overall platform-level arrears rate. Now, if you just looked at the overall arrears rate, you would get completely the wrong impression, because you would see that at the platform level, the blue line on both charts, with different scales, shows you that Zopa's arrears rate has increased in the last 18 months. And arguably, you could jump to the wrong conclusion and say something's changed in terms of the like-for-like performance of their risk grades. Actually, that couldn't be further from the truth. If we look in the left-hand panel, we see a series of Zopa's biggest risk grades and how arrears have trended. And you can see that it's inevitably quite a noisy series, but in the A star, and A1 risk grade, all those are incredibly low levels of arrears, and they're all bouncing around within the historic range. There is no indication that this loan book is behaving in anything other than the way that it's been behaving in the last 2 or 3 years. What has affected Zopa's overall arrears line is the addition of new risk grades. Now on the right, we see some higher arrears numbers, 2-3%, but these are new risk grades that are getting originated at interest rates in the high teens. Those are perfectly reasonable arrears rates, And that is what's pushing the overall platform level arrears rates up. So it's important to recognize that when we deliver proper disclosure, we have to deliver the full granularity behind it. We can't just try and represent net lending track record. We have to also deliver all the other metrics that help people put this in context and stop people from oversimplifying the analysis. All this data can also be put in a format which is highly consumable. Rather than asking people to go to the individual platform website and extract the data, we can put it all in one place and we can compare it on a like-for-like basis. So these are bad debt cohorts, annual cohorts measured in months since origination. We can look at this this is aggregate industry bad debt. We can look at this at the platform level. We can look at this at the borrower level. We can look at this at the security type level. We can look at it on a quarterly basis, on an annual basis. It's infinitely customizable, and it's in a language that international credit markets speak. And finally, our hope is that by providing all the background and the granular detail, we can help provide a single quantitative objective standard that allows investors to appraise what they need to understand, which is net lending track record. Whether it's an IFA trying to prove suitability, or an institution trying to decide, or an institutional risk manager trying to decide if this should go in his fund manager's mandate, investors want to understand what has the track record been of an individual platform or the asset class as a whole to match loans at a sensible interest rate such that there is a positive net return. And by delivering this data on a like-for-like basis, we think we can hugely facilitate the process of doing due diligence. So let's just review what's out there at the moment in terms of standards of disclosure and the problems. Platform-derived data is generally lacking credibility because it's not aggregated by independent third parties. It's not comparable because calculation methodologies are different. It is improved with standard definitions, but unless we can crack split the atom, frankly, of finding a consistent calculation methodology that everyone can agree on, I think it'll remain very difficult to go down that road. Static loan book disclosure represents the right intent, but practically it's not allowing investors to really do any due diligence and really scrutinize the returns. So we think loan-by-loan cash flow data can deliver what's needed. And we think, therefore, the time has come for the industry to embrace what we call Transparency 2.0. And that is coalescing or accepting some kind of quantifiable, objective, unambiguous standard where we can genuinely offer due diligence on asset performance on a like-for-like basis. And when we think about that standard, I would urge us to consider these 4 Cs, what I would call the 4 Cs of effective disclosure, of Transparency 2.0. We need to produce data in a format that is comparable, consistent, consumable, and credible. That means subjectivity should be avoided, surveys should be avoided. We should not aggregate survey data. We should not cut corners. We must make sure that alternative doesn't just mean different, it means better than what came before. And at this point, I would urge European platforms who I would imagine are thinking how helpful it would be to have a strong industry body, and it would, and how helpful it would be to have a dedicated regulatory framework, and undoubtedly it would. But with regard to disclosure, I don't think they should feel so far behind. I think they should recognize that actually there are some lessons being learned already, and we've tried very hard to deliver disclosure in a number of ways, but actually the independent third-party approach seems to deliver it effectively. So with that, I would be delighted to open up for any questions. I genuinely believe that if we can encourage this kind of high standard of disclosure, it's uncomfortable, it's complex. But I genuinely believe it will allow us to open up access to really major cohorts of investors that recognize the high returns this asset class has to offer, that recognize that it's a diversifier, but just need to be able to do due diligence on a mass scale.